Imagine a financial empire built not on intellect, but on human chattel. A fortune forged not within gleaming glass towers, but amidst the oppressive, blood-soaked cotton fields of the Deep South. When Lehman Brothers vaporized in 2008, erasing $613 billion in a single heartbeat, the world mistook it for a mere banking failure. They were wrong. It was the final, violent chapter of a 158-year dynasty built upon the bedrock of human misery. To understand this cataclysm, we must look far past the steel and stone of Manhattan, back to the sweltering heat of Alabama in 1844. The Lehman fortune did not begin with municipal bonds or sophisticated speculative banking. It began with the commodification of life itself, with cotton stained by the labor and suffering of the brutally exploited. It was a foundational sin, extracted from one of history's most barbarous economic systems, while some heirs, like Herbert H. Lehman, sought to redeem the family name through public service and civil rights. He remained the noble exception, not the rule. The true DNA of the empire was encoded by Henry, Emmanuel, and Mayer, men whose unyielding ambition knew no moral boundaries, the same amoral appetite for risk that made them pioneers in the slave trade eventually led their successors to pioneer subprime mortgages and toxic derivatives. The instruments changed, but the instinct remained: a relentless, institutionalized greed that would eventually cause the global economy to buckle and break. This is the story of how an empire built on the chattel economy finally collapsed under the unbearable weight of its own predatory soul. The system had no answer. To trace the origins of that predatory soul, we must travel back more than a century. The morning of September 13th, 1844, was the silent inflection point for the Lehman family, although no one, least of all Henry himself, could have possibly predicted its significance. Henry Lehman, barely 23 years old, carrying his life in a single battered leather trunk and precisely $900, a respectable sum, but hardly startup capital, stepped off the steamboat onto the humid wharf of Montgomery, Alabama. Interestingly, Henry didn't just carry the money in his pocket. He arrived with exactly $900 sewn into his coat lining, a sum worth roughly $35,000 today, and his only lifeline for survival in a new world. He was utterly unaware that he was about to commence the founding process of the most enduring financial dynasty in American history. Henry Lehman, a young Jewish immigrant from the tiny, restrictive Bavarian village of Rimpar, where his family had been marginalized cattle dealers for generations, understood none of this sophisticated macroeconomic analysis upon arrival. In Bavaria, restrictive anti-Jewish laws dictated where they could live, what professions they could hold, and even who they could marry. America represented not just freedom, but an economic opportunity that was fundamentally impossible in the old world. But Henry possessed an asset far more valuable than academic knowledge or formal capital: an absolutely cold, brutal instinct for financial opportunity. Within days of his arrival, he had identified the precise current where the money was flowing and strategically positioned himself to siphon off the maximum amount possible. He quickly rented a small, prominent storefront at 16 Court Square, situated in the very epicenter of Montgomery's commercial district, just 2 critical blocks from the Cotton Exchange, where transactions worth millions were executed daily. The location was a calculated decision. Henry had meticulously studied the flow of commerce and concluded that virtually every major player involved in Montgomery's lucrative cotton trade would pass directly by his door: Lehman Brothers and Company. Though at this stage, it was only Henry working the counter alone. Opened for business on October 1st, 1844, his initial inventory was standard: basic dry goods, rudimentary farming tools, household necessities, and simple clothing imported from northern manufacturers. Nothing outwardly differentiated Henry's store from the dozens of other establishments dotting the Deep South. What made Henry's model revolutionary was his dangerous willingness to accept raw cotton as payment instead of demanding hard cash. This seemingly innocuous business practice would prove to be one of the most critical financial innovations in the history of the Deep South's economy. Most general store owners strictly insisted on cash payment because cotton prices were notoriously volatile, and storing bulky cotton bales required expensive, dedicated warehouse space. Henry immediately recognized that this restrictive, cash-only, policy instantly excluded a massive customer base, the wealthy, powerful plantation owners who were cotton rich but cash poor between annual harvest seasons. By accepting cotton as payment, Henry was doing more than just selling goods. He was simultaneously providing crucial lines of credit and transforming himself into an essential cotton commodity trader. When customers paid him in cotton, he would store the bales meticulously, time the sales to capture peak pricing, and pocket the price difference as additional, exponential profit. This novel system had three profound consequences. First, it made Henry's store the indispensable hub for plantation owners struggling with cash flow flexibility. Second, it instantly transformed him from a simple retailer into a sophisticated commodity trader with deep, intimate, and proprietary knowledge of local cotton production schedules and pricing mechanics. Third, it immediately established essential financial relationships with the plantation owners, the true, entrenched economic power base in Alabama's economy. Perhaps most critically, this practice made Henry Lehman a direct, central participant in the slavery-based economy that fueled Alabama's immense wealth. Every single cotton bale he accepted represented the unpaid, coerced labor of enslaved African Americans. Every transaction he facilitated financially helped perpetuate and expand the system of human bondage. The moral stain was even more personal than the business model. The 1860 U.S. Census explicitly lists Mayor Lehman as the owner of 7 enslaved people, ranging from ages 5 to 50, who worked either in his household or for the firm itself. This was not accidental participation. It was the calculated, ruthless exploitation of the single most profitable economic opportunity available to him. Henry's business philosophy was startlingly uncomplicated. Identify the financial current and position yourself to capture the maximum flow, regardless of moral interference. This amoral approach would define the Lehman Brothers corporate culture for the following 164 years. This wasn't just a personal choice. It was a cold calculation. By 1846, a mere 2 years after opening, Henry's humble general store was generating significantly more revenue than rival businesses that had been operating for decades. His strategic flexibility in accepting cotton had secured the loyalty of powerful plantation owners who desperately needed credit extension. His acute ability to time and execute cotton sales had generated substantial trading profits on top of his retail margins. More importantly, Henry had begun to fully internalize the vast global economic system he was operating within. The cotton grown in Alabama was shipped to sophisticated textile mills in Massachusetts and England, where it was manufactured into finished goods that were sold worldwide. The Alabama plantation owners were merely raw material suppliers in a massive global manufacturing chain that generated colossal profits at every single stage. Henry realized that the greatest, most enduring fortunes would not be made by simply growing cotton or selling spades to the growers. The real power lay in controlling the complex financial mechanisms that connected Alabama's producers to the world's markets. He needed to become the indispensable middleman, the facilitator who monetized those connections. This profound realization perfectly coincided with the timely arrival of his younger brothers. Emanuel Lehman arrived from Bavaria in 1847, bringing essential additional capital and sophisticated, formal knowledge of established European commercial practices. Mayor Lehman followed in 1850, possessing that almost mystical ability to analyze chaotic markets and predict precise price movements. Together, these three brothers rapidly transformed their simple general store into something far more ambitious, a comprehensive, vertically integrated cotton trading operation that would eventually evolve into one of the most powerful and ruthless financial institutions in the history of the world. But first, they needed to consolidate their iron-fisted control over Alabama's cotton trade and figure out how to rapidly transform local dominance into national financial influence. They needed to survive the escalating political tensions over slavery that threatened to violently tear the country apart. And they needed to expertly position themselves to profit, regardless of which side ultimately won the coming conflict. The Lehman brothers were about to discover that their greatest operational strength was not their business acumen or their financial innovation. Their single greatest strength was their complete, institutionalized absence of moral constraints when the pursuit of profit was on the line. In an economy explicitly built on the commodification of human bondage, moral flexibility was not merely an advantage. It was absolutely essential for exponential success. By 1850, the transformation was complete and absolute. What had begun as Henry Lehman's modest, single general store had rapidly evolved into the most sophisticated, high-volume cotton trading and credit operation in the state of Alabama. The faded wooden sign reading H. Lehman dry goods had been replaced with elegant, commanding painted lettering announcing Lehman Brothers, cotton merchants. This simple sign change signaled far more than a cosmetic improvement. It announced the birth of a financial dynasty poised to dominate American capitalism for the next 158 years. Emmanuel and Mayer's arrival provided capabilities that Henry alone could never have achieved. Emmanuel possessed the formal business education from established European commercial houses and understood the complex mechanics of international trade and letters of credit, mechanisms largely foreign to most American merchants. Mayer, the mathematical savant, possessed an almost mystical ability to predict cotton price movements and forecast yields, a consistency that amazed their competitors and instantly secured the confidence of their customers. Together, the three brothers created something unique in the volatile antebellum South, a fully vertically integrated cotton trading operation that sought to control every single aspect of the supply chain, from pre-season plantation financing right up to the final international sale. Here is how their sophisticated system operated and why it generated such staggering, exponential profits. Traditional cotton trading involved multiple layers of independent middlemen, each taking a transactional percentage. Plantation owners sold to local buyers, who sold to regional distributors, who sold to shipping agents, who finally sold to distant northern or European textile mills. By the time the cotton reached its final destination, the original plantation owner might have received less than 60% of the ultimate sale price. The Lehman brothers aggressively eliminated most of these intermediary layers by creating an integrated operation that handled everything internally. They would provide upfront financing and essential supplies to plantation owners during the planting season. They would accept the entire harvest as repayment, plus substantial interest. They would store the cotton in their own dedicated warehouses meticulously, time the sales to capture optimal peak pricing, and ship directly to textile mills with whom they had established long-term relationships. This integrated system generated cascading profits at multiple, simultaneous stages. They earned solid retail margins on the goods sold to planters. They earned high interest on the credit extended during the growing season. They earned massive trading profits by timing the commodity sales strategically. They earned shipping commissions by managing the transportation logistics. And they earned long-term relationship premiums by making themselves utterly indispensable to both the plantation owners who supplied the commodity and the textile mill operators who needed a reliable supply chain. But the true genius of their financial approach lay in understanding a factor that other merchants missed. Cotton was not merely an agricultural commodity. It was the fundamental backbone of a global financial system that generated wealth far beyond simple buying and selling. By 1850, cotton represented roughly 60% of all American exports. The enormous revenues generated from cotton sales provided the majority of the foreign currency that America relied upon to purchase manufactured goods from Europe. Cotton-backed securities were among the most liquid and popular investments on the London and New York financial markets. Cotton wealth provided the vital capital that funded American infrastructure development. From canals to railroads to telegraph lines, the Lehman brothers positioned themselves not just as successful cotton traders, but as essential, deeply entrenched facilitators of this entire global financial ecosystem. They were not simply buying and selling a crop, they were actively managing one of the key industrial engines of international capitalism. Their Montgomery operation rapidly expanded to encompass multiple buildings around Court Square. The main store remained at number 16, but they quickly expanded to include dedicated, large cotton warehouses, administrative offices, and even a small, informal banking operation that provided essential commercial credit to customers throughout central Alabama. More crucially, Emmanuel had begun establishing deep, powerful relationships with critical northern financial institutions that would prove fundamental to their long-term survival and success. He made frequent, meticulous trips to New York, cultivating connections with textile mill operators, shipping magnates, and ambitious investment bankers who were desperate to secure reliable southern cotton sources. These northern relationships represented a calculated, significant risk. Many southern merchants viewed trade connections with northern businesses as potentially disloyal, especially as political tensions over slavery intensified throughout the 1850s. But the Lehman brothers operated purely on market logic. They understood that their long-term viability depended on maintaining access to global financial markets, regardless of the inevitable political developments. By 1855, Lehman Brothers was efficiently handling approximately 15% of all cotton shipped from Montgomery, establishing them as the largest cotton trading operation in Alabama and one of the most influential in the entire South. Their annual revenues exceeded $500 million, equivalent to approximately $15 million today, and they had accumulated capital reserves that made them formidable, major players in Alabama's financial ecosystem. But their success came at a moral price that was staggering. Even by the permissive standards of the antebellum South, the Lehman brothers were not reluctant, passive participants in the system of slavery. They were active, willing enablers and deep financial backers of human bondage on an industrial, optimized scale. Their credit operations alone systematically facilitated the purchase of hundreds of enslaved people. When plantation owners required capital to aggressively expand their operations, Lehman Brothers would provide structured financing specifically earmarked for the purchase of new enslaved workers. They meticulously calculated the loan amounts based on projected cotton production, which was directly tied to the number of enslaved laborers a plantation could field. Their warehouse operations processed cotton picked by thousands of unpaid, enslaved laborers. Their vast trading profits were extracted directly and efficiently from the economic value of unpaid human labor. Their entire sophisticated business model was fundamentally dependent on the perpetuation and aggressive expansion of chattel slavery. The brothers even developed sophisticated financial instruments for managing slave-based agriculture that would not have looked out of place on modern Wall Street. They created early forms of crop insurance policies that protected plantation owners against weather-related yield losses. They established forward contracts that allowed planters to lock in cotton prices months before the actual harvest. They even pioneered early forms of commodity derivatives that allowed speculative betting on future cotton price movements. These financial innovations generated enormous profits, but they also made the brothers utterly indispensable to Alabama's slave-based economy. Plantation owners across the state relied solely on Lehman Brothers for flexible financing, insurance, marketing, and trade facilitation. Local banks depended on them for market intelligence regarding crop conditions and market trends. Even state government officials consulted the brothers on crucial economic policy issues. The Lehmans had achieved something remarkable. They had made themselves essential to an economic system that generated some of the greatest wealth in modern history, while simultaneously maintaining enough operational flexibility to survive potential catastrophic political changes. This ruthless flexibility would prove absolutely crucial as the 1850s wore on and political tensions over slavery reached a violent breaking point. The Lehman brothers coldly anticipated that conflict was inevitable, but they were strategically confident they could profit regardless of the outcome. If the South achieved independence, they were positioned as the leading financial figures in the new Confederate nation. If the North won and abolished slavery, they possessed the essential Northern relationships and the capital necessary to seamlessly transition into whatever new economic system replaced the plantation model. What the brothers could not fully anticipate was how violently and completely the Civil War would shatter and transform American capitalism, and how their absolute willingness to profit from any situation, regardless of the human cost, would enable them not only to survive the conflict, but to emerge infinitely more powerful than before. The war that was meant to destroy the slave economy would paradoxically provide the unexpected foundation for Lehman Brothers' rapid expansion into undisputed Wall Street dominance. The same moral elasticity that allowed them to build their initial fortune on human bondage would allow them to instantly reinvent themselves as patriots, calculated war profiteers, and eventually, the indomitable titans of American finance. The first volley of shots fired at Fort Sumter on April 12, 1861, should have catastrophically destroyed everything the Lehman brothers had meticulously constructed. Their entire financial fortune was intrinsically tied to cotton, to slavery, and to the foundational economic system of the Old South, all of which were now under direct, full-scale military attack by the most powerful industrial nation on earth. Most rational observers expected the agrarian confederacy to implode within months and the entire cotton-based economy to vanish forever. The Lehman brothers saw an unparalleled opportunity where others saw only existential catastrophe. While other Alabama merchants spiraled into panic and frantically attempted to liquidate their holdings at devastating losses, the Lehmans made a series of calculated, cold-blooded strategic bets that would not only perfectly preserve their accumulated wealth, but multiply it exponentially through the next 4 years. They understood a central truth that most people missed. Wars do not destroy money. They simply violently redirect capital toward whoever is clever and ruthless enough to position themselves as absolutely essential to the war effort. The brothers' first strategic decision was counterintuitive, immediate, and utterly brilliant. Instead of attempting to protect their existing, highly vulnerable cotton inventory, they immediately began converting their substantial warehouses into secure storage and distribution facilities for military supplies. By May 1861, just 1 month after the war began, their Montgomery operation was aggressively handling Confederate government contracts for everything from uniforms and specialized weapons to critical food supplies and medical equipment. This transition was far more than simply changing inventory. It represented a fundamental, total transformation of their business model from regional cotton merchants to industrial-scale war profiteers, and they were spectacularly effective at it. Emanuel Lehman's meticulously cultivated relationships with northern manufacturers during the 1850s now proved invaluable and lethal. While publicly maintaining an enthusiastic posture of supporting the Confederacy, he simultaneously and secretly maintained complex communication lines with Union suppliers who were desperately eager to sell their excess goods to anyone who could pay in hard currency gold or foreign exchange. This created opportunities for complex high-risk arbitrage operations that generated enormous, untaxed profits. Here is how their sophisticated wartime trading system worked. Confederate military units desperately needed supplies from gunpowder to blankets that Southern manufacturers simply could not produce in sufficient quantity. Northern manufacturers had massive excess production capacity, but were legally forbidden from trading with Confederate buyers. The Lehman brothers became the essential, high-priced, and invisible middleman who expertly facilitated these transactions. They would purchase goods from Northern suppliers using gold or European foreign currency, ship them covertly through neutral ports in Mexico or the Caribbean, and deliver them to Confederate military buyers at markups that sometimes exceeded 500%. Both sides benefited. Union manufacturers received instant cash sales, Confederate units received essential supplies, and the Lehmans captured the enormous premium associated with circumventing the massive Union naval blockade. But their most profitable and most innovative financial venture was something they shrewdly termed cotton futures. Essentially the world's first systematic, large-scale commodity derivatives market. The brothers recognized that while cotton could not be physically shipped during the war, due to the effective Union naval blockade, European textile mills would be absolutely desperate for Southern cotton the moment the conflict inevitably ended. They began generating crucial wartime liquidity by issuing fixed price contracts for future cotton delivery. They collected immediate payment in cash, often specie or internationally recognized currency, in exchange for a binding promise to deliver the commodity once hostilities ceased. This sophisticated mechanism provided an essential, instant cash infusion, while effectively placing a colossal wager on either a decisive Confederate triumph or, at the very least, a peace treaty that would guarantee the swift reopening of global cotton routes. These complex futures contracts were an immediate sensation, particularly among desperate European textile buyers who needed to lock in guaranteed supply lines regardless of the war's shifting fortunes. Simultaneously, Confederate planters, starved for immediate operating capital to finance their military contributions, found a ready buyer for their future harvests. The Lehmans swiftly solidified their position as the indispensable financial nexus for these transactions, extracting hefty commissions from both the needy European merchants and the cash-strapped Southern producers, all while amassing perhaps the largest single inventory of physical cotton in the Confederacy. It was in structuring these arrangements that Mayor Lehman's financial brilliance truly crystallized. He moved far beyond simple bilateral purchase agreements, engineering intricate financial instruments laden with layered protections. These included explicit price guarantees against wartime inflation, robust delivery insurance to mitigate the risk of seizure or destruction, and pioneering currency hedging mechanisms designed to protect the value of the final settlement against the inevitable depreciation of the Confederate dollar. By 1863, Lehman Brothers was executing more substantial contracts for the Confederate government than any other private firm in the state of Alabama. Their sprawling warehouses in Montgomery became vital logistical hubs, storing not just cotton but military ordnance and essential supplies valued in the millions. Their aggressive trading operations soon eclipsed the profits earned by their entire pre-war cotton commission business, and the sheer volume of their futures contracts generated financial obligations stretching into the tens of millions of dollars. Yet, amidst this escalating prosperity, the brothers possessed the cold-eyed clarity to recognize the war's terminal trajectory. The value of Confederate currency was plummeting toward utter worthlessness. The South's already sparse infrastructure was being methodically dismantled. The tightening Union naval blockade was effectively strangling international commerce, and General Sherman's devastating march signaled an unsparing Northern intent to crush the Southern economic backbone entirely. Consequently, in early 1864, the Lehmans made their most calculated and audacious survival maneuver. They initiated confidential negotiations with Union authorities for a strategic defection. Emmanuel Lehman, using established Northern business contacts who could credibly attest to the firm's reliability and immense utility, opened lines of communication with high-ranking Union military commanders. These discussions were fraught with peril. The Lehmans had to prove their potential value to the Union war effort without appearing to be mere opportunistic spies or disloyal Confederates. Their proposition was brutally pragmatic and inherently persuasive. In exchange for ironclad protection of their vast assets and authorization to continue all trading activities under federal jurisdiction, they offered to supply Union forces with granular, detailed intelligence regarding Confederate supply networks, manufacturing capacity, and the vulnerabilities of its financial operations. This insider knowledge proved to be an invaluable windfall for Union military planners. The Lehmans held intimate, systematic insight into the Confederate logistical web, supplier networks, and the precise financial pressure points. This intelligence allowed Union forces to prosecute the war with surgical efficiency, targeting critical choke points in supply chain, identifying the Southern manufacturers most vital to munitions production, and knowing exactly which financial institutions were most susceptible to immediate pressure and collapse. In return for this systemic intelligence, Union commanders guaranteed the protection of Lehman Brothers facilities when Montgomery inevitably fell, and permitted them to maintain operations under necessary military supervision. This promise became the ultimate shield when federal forces occupied Montgomery in April 1865, while dozens of other Confederate-affiliated businesses saw their assets seized, their buildings destroyed, or their principals severely penalized. Lehman Brothers executed a seamless transition, immediately pivoting to serve the needs of the Union occupation forces. Their warehouses, which had stored uniforms and gunpowder just weeks prior, were instantly restocked with essential provisions for Union administrators and Northern entrepreneurs looking to establish a foothold in the devastated South. But the firm's most spectacular financial escape involved those outstanding cotton futures contracts. Upon cessation of hostilities, cotton priced at $1 per pound in defunct Confederate currency was suddenly valued at a mere 15 cents per pound in sound Union currency, thanks to the complete annihilation of the Confederate monetary system. In theory, this reversal should have rendered the Lehmans instantly bankrupt, as they were obligated to deliver cotton at the inflated pre-war prices. Instead, Mayor Lehman deployed his negotiating prowess, securing settlements with European buyers that converted their Confederate currency obligations into Union currency at expertly managed, negotiated exchange rates. These rates successfully protected the interests of the buyers while simultaneously preserving the crucial profit margins of Lehman Brothers. These brilliant settlement agreements did more than save the firm. They established foundational legal precedents for international commodity trading that would influence financial jurisprudence for decades. The outcome was nothing short of miraculous. While the vast majority of Southern merchants emerged from the Civil War ruined or severely hobbled, Lehman Brothers had dramatically increased their total wealth and expanded the scope of their business. Their tactical agility, their calculated provision of intelligence to the Union, and their pioneering use of complex financial instruments had insulated them completely from the economic catastrophe that obliterated their rivals. By late 1865, they controlled more high-value cotton inventory than they had before the war began. They had cultivated critical relationships with victorious Union military authorities and powerful Northern business interests, opening up entirely new commercial horizons. Crucially, they had accumulated enough liquid capital to begin thinking far beyond the regional confines of Alabama, setting their sights on national markets. More profoundly, they had codified the core operating principle that would define Lehman Brothers' strategy for the next 143 years. Ideology and regional loyalty were negligible compared to raw profitability, and long-term survival necessitated the ruthless willingness to completely reinvent oneself as dictated by circumstances. The brutal crucible of the war had taught them that the truly great fortunes are forged during periods of maximum societal chaos and uncertainty, when established business models disintegrate, creating unprecedented vacuums for the cunning and quick-witted to exploit. This hard-won lesson would be their compass as they prepared to abandon Alabama and attempt the conquest of Wall Street. The Cotton Empire, built initially upon the dark foundation of slave labor wealth, had survived its ultimate test, emerging not just intact, but exponentially stronger. Now, the task was to transmute those profits into something far grander, a financial dynasty poised to dominate American capitalism for generations. Despite amassing a fortune from the slave economy, the Lehman Brothers understood that the South was a pond too small and increasingly precarious. As the drums of the Civil War began to thunder, threatening to obliterate the plantation system, the Lehmans chose not to perish with Alabama. Instead, they glimpsed a path to rebirth through the smoke of conflict. They began shifting their capital northward, orchestrating a historic migration to the place where the true current of the future was flowing, New York City. The telegram that reached the Lehman Brothers' Montgomery office on the morning of March 15, 1866, contained a mere dozen words, yet those words carried the seismic force necessary to permanently reshape the landscape of American capitalism. Transcontinental Railroad approved. Unlimited government funding. Moved to New York immediately. Opportunities unprecedented. The message originated from Emanuel Lehman, who had spent the preceding 6 months conducting detailed reconnaissance in New York City, diligently scouting the monumental business opportunities poised to explode as the nation embarked on its monumental post-Civil War reconstruction. What he reported back far exceeded the brothers' most extravagant expectations. The federal government was preparing to initiate the largest program of infrastructure development ever funded by any governing body in human history. The Transcontinental Railroad, while massive, was only the opening salvo. Congress had authorized the construction of nearly 150,000 miles of new track, slated to connect every significant city in the nation and unlock the vast, untapped territories of the West for economic development. The estimated capital expenditure for this project would exceed $3 billion, the modern equivalent of roughly $60 billion. And the vast majority of this capital needed to be raised by private corporations through complex bond sales and stock offerings. For financial intermediaries possessing the requisite expertise and high-level political connections, these infrastructure projects represented profit potential that utterly dwarfed anything the lucrative cotton trade had ever offered. The Lehman Brothers instantly grasped that America was on the cusp of its greatest economic expansion, and they intended to position themselves precisely at the epicenter of that inevitable growth. The decision to relocate their primary operations to New York demanded the abandonment of everything they had meticulously built in Alabama. However, the brothers understood that regional dominance, however profitable, meant nothing compared to national, systemic influence. In September 1866, they established Lehman Brothers' first Wall Street headquarters at 119 Liberty Street, strategically located just 3 blocks from the New York Stock Exchange. The New York financial district of 1866 bore no resemblance to the provincial commerce the brothers had known in Alabama. Instead of simple cotton warehouses and general stores, Lower Manhattan was dominated by colossal granite buildings housing sophisticated banks, investment houses, and specialized trading firms that managed dizzying capital flows worth hundreds of millions of dollars. Telegraph cables connected New York traders instantaneously to London, Paris, and Frankfurt, enabling lightning-fast arbitrage opportunities that could generate substantial profits within hours. Most critically, New York was the primary capital clearinghouse, the place where railroad magnates came seeking the immense sums required for their continent-spanning construction ventures. Any ambitious investment bank capable of successfully underwriting major railroad bond offerings stood to earn fee income that could easily surpass the annual profits of entire southern plantations. The brothers' first major breakthrough came through their established relationship with the Alabama and Chattanooga Railroad. This line desperately needed $2 million in complex financing to complete the crucial link between Montgomery and Tennessee. Most established northern banks deemed the proposition too risky, citing the recent history of Southern Railroad defaults during the war. However, the Lehmans intimately understood the strategic necessity of connecting Alabama's agricultural heartland into the burgeoning national transportation grid. Rather than providing a standard loan, they structured a highly innovative financial arrangement that would eventually serve as the blueprint for modern investment banking practices. They created meticulously tiered bonds, collateralized not by physical assets, but by the railroad's projected future revenues. They successfully marketed and sold these bonds to European investors, who were actively seeking higher yields than those offered by conservative European government security. Furthermore, the Lehmans retained strategic warrants, which gave them the right to purchase the railroad's stock at a predetermined, favorable price should the company succeed. This structure provided the firm with 3 immediate revenue streams: instant fee income from the bond sales, sustained income from serving as fiscal agents, managing bond payments, and the enormous potential for equity profits should the railroad's value appreciate. When the Alabama and Chattanooga subsequently became highly profitable and its stock price more than tripled, the Lehmans' warrant positions generated more profit than their entire cotton trading operation had produced in any single year. Crucially, the stunning success of this initial railroad financing immediately cemented Lehman Brothers' reputation as highly innovative investment bankers, capable of structuring complex deals that satisfied the needs of all parties involved. The company, the investors, and the underwriters. Word quickly propagated across Wall Street. The former Alabama cotton merchants had developed sophisticated, unique approaches to infrastructure financing that consistently delivered superior returns. By 1868, Lehman Brothers was actively engaged in railroad financing throughout the recovering South and was beginning to aggressively compete for major northern projects. Their deep southern connections provided them with unique, proprietary insights into reconstruction opportunities that traditional northern banks simply could not match. Moreover, their background in cotton trading had refined their ability to analyze commodity flows, logistical risk, and transportation efficiency far more effectively than conventional finance specialists. The brothers developed a specialized vertical they dubbed development finance, the strategic art of identifying regions with latent economic potential and structuring complex investments that generated substantial profits while simultaneously constructing essential physical infrastructure. This methodology required a deep grasp not only of financial markets, but also of geography, emerging demographics, agricultural potential, and industrial development patterns. Their most spectacular early success in this field involved the Louisville and Nashville Railroad, L&N, which required an immense $15 million to significantly expand its network across Kentucky, Tennessee, and Alabama. This was a monumental project designed to link crucial coal mining regions to distant industrial centers and agricultural zones to coastal shipping ports, a transformation that promised to reshape the economy of the entire Mid-South, where established investment houses hesitated, viewing a $15 million Southern Railroad offering as excessive risk. The Lehmans saw unparalleled opportunity. They recognized that the L&N network controlled strategic transportation choke points that would become exponentially more valuable as the national economy boomed. They structured the L&N financing not as a single offering, but as a meticulously orchestrated series of smaller bond tranches, each specifically targeted at different investor risk appetites. They offered conservative bonds for major institutional clients, like pension funds and insurance companies. Higher yield securities were marketed to wealthy private individuals seeking reliable income, and convertible instruments were created for aggressive speculators betting on long-term transportation sector growth. This segmented, financially engineered approach allowed them to successfully raise the full $15 million while simultaneously appealing to a maximally broad investor base with varying risk tolerances and return mandates. More importantly, it demonstrated a level of financial engineering sophistication that genuinely impressed even the oldest Wall Street firms, attracting the keen attention of the country's most important railroad developers. The triumph of the L&N offering brought Lehman Brothers directly to the notice of Jay Cooke, the reigning titan of American investment banking and the primary financier of the Union war effort. Cooke was then organizing the colossal financing needed for the Northern Pacific Railway, a venture intended to link the Great Lakes to the Pacific Ocean, requiring more capital than any private sector project in American history. Cooke invited Lehman Brothers to join his consortium as a highly valued junior partner in the Northern Pacific Financing Syndicate. This invitation signified the firm's definitive entry into the highest echelon of American finance and provided their first opportunity to participate in truly national, continent-spanning infrastructure development. The sheer scope of the Northern Pacific project was staggering. 2,000 miles of track laid across largely unsettled territory, necessitating massive bridges over major rivers, tunnels through imposing mountain ranges, and complex coordination with dozens of state and territorial governments. The total projected cost would exceed $100 million equivalent to roughly $2 billion in modern funds, and its successful completion promised to unlock vast Western territories for immediate economic development. For the Lehman Brothers, participation in the Northern Pacific financing represented the culmination of their complete transformation from provincial Alabama cotton merchants into leading Wall Street investment bankers. They were now managing transactions that would literally redraw the economic geography of the United States. However, they were simultaneously about to discover that railroad financing carried risks and explosive opportunities that utterly dwarfed anything they had ever experienced in the volatile cotton trade. The same forces that could generate unprecedented profits were capable of unleashing catastrophic financial losses that would once again test their ability to survive. The railroad boom that had catapulted them to Wall Street prominence was suddenly poised to turn into the railroad crisis that would either destroy them completely or forge them into one of the most powerful financial institutions in America. Participation in the Northern Pacific Syndicate provided the Lehmans with more than just profit. More crucially, it offered them a front-row seat to the internal decay of the era's reigning giants. As the railroad bubble expanded to its breaking point, and Wall Street remained intoxicated by its own success, the Lehman Brothers were quietly preparing for a collapse they viewed as inevitable. When the nightmare of 1873 finally struck, it was not an ending for them, but a predatory opportunity for the most ruthless survivors to seize the throne. The Panic of 1873, a brutal and sweeping economic collapse, should have irrevocably destroyed Lehman Brothers. J. Cook & Company, the most powerful investment bank in America and the firm's principal partner in the Northern Pacific Railway venture, imploded spectacularly on September 18th, triggering the worst financial crisis in the nation's history. Most cynical Wall Street observers fully expected the former Alabama cotton merchants to vanish quietly, taking their place alongside the dozens of other distressed firms incapable of weathering the sudden economic devastation. Instead, the Lehmans masterfully exploited the crisis, not just to survive, but to eliminate their weakened competition and firmly establish themselves as one of the three most influential investment banking houses in New York City. Their secret weapon was not superior financial modeling or better political lobbying. Their secret was the same moral flexibility and ruthless pragmatism that had enabled them to profit from chattel slavery, execute a perfect mid-war defection, and pivot instantaneously from volatile cotton trading to high-stakes railroad finance. They maintained an unwavering willingness to undertake any necessary action required for survival and profit, regardless of the consequences for their partners or the broader public. The 1873 crisis began when European institutional investors lost confidence in the increasingly over-leveraged American railroad securities market and began demanding immediate repayment of loans that were scheduled to mature years in the future. This sudden and massive capital flight instantly triggered a catastrophic liquidity crisis that rapidly metastasized from the railroad companies themselves to the banks and investment houses that had funded them. Within a few terrifying weeks, more than 5,000 businesses declared insolvency. Unemployment skyrocketed to a crippling 14%, and the New York Stock Exchange, in an unprecedented move, closed its doors for 10 consecutive days, the first prolonged closure in its history. Most conventional investment banks responded to the crisis by desperately liquidating assets, aggressively calling in outstanding loans, and hoarding cash reserves to meet immediate obligations. This standard approach made logical sense from a conventional risk management standpoint, but it simultaneously meant accepting crushing losses on core investments that might otherwise recover if held patiently. The Lehman Brothers adopted a fundamentally contrarian strategy. Instead of fire-selling their assets, they began aggressively purchasing distressed railroad securities at massive discounts from panicked, desperate sellers. Instead of foreclosing on debtors, they extended additional, strategic credit to companies they concluded were structurally sound enough to weather the temporary storm. Instead of conserving their capital reserves, they deployed their cash strategically to acquire the most valuable operational assets of failing competitors. This high-stakes strategy required an extraordinary combination of financial discipline, deep proprietary research, and immaculate market timing. The brothers needed to accurately distinguish between companies suffering from temporary financial distress, solvency issues, versus those that were fundamentally and hopelessly unsound liquidity issues. They had to maintain sufficient liquidity to service their own ongoing obligations, while simultaneously keeping enough capital free to aggressively capitalize on the opportunities the crisis presented. Most importantly, they needed the psychological fortitude to place gargantuan financial bets when the entire financial community around them was paralyzed by fear and uncertainty. Mayor Lehman's analytical genius proved absolutely crucial during this period. While other financiers succumbed to panic, he spent 18 hours a day meticulously studying the financial statements of major railroad companies, analyzing their complex root structures, and calculating their long-term profitability potential. His internal conclusions were astonishingly simple. Most railroad companies were not actually insolvent. They were merely experiencing acute, temporary cash flow problems induced entirely by the systemic liquidity crisis. The brothers' most audacious move came in November 1873, when they purchased a controlling interest in the bankrupt Philadelphia and Reading Railroad P&R for just $3 million, approximately 20% of its value prior to the panic. This acquisition stunned Wall Street. P&R had been considered one of the financial behemoths of American rail transport before the crisis, and most observers assumed it would languish in receivership for years. But the Lehmans had isolated a fact that others missed. PNR controlled the vital coal transportation network, running from the richest Pennsylvania mining regions directly into the industrial hubs of Philadelphia, New York, and Boston. Coal was rapidly becoming the single most essential industrial fuel of the Gilded Age, and PNR's route network represented an unassailable strategic choke point whose value would multiply exponentially as the economy recovered. The Lehman swiftly restructured PNR's finances, converting high-interest debt into equity, renegotiating labor contracts to drastically reduce operational costs, and modernizing equipment to maximize efficiency. More importantly, they leveraged PNR's near monopoly on regional coal transportation to secure long-term supply contracts with major steel mills, nascent power plants, and industrial manufacturers. These contracts guaranteed reliable, steady revenue streams, regardless of wider fluctuations in the general economic environment. When the national economy began its robust recovery in 1875, PNR's stock price surged by over 800%, generating more profit for Lehman Brothers than their entire cotton trading operation had produced over 2 decades. The financial gain, however, was secondary to the strategic positioning. Ownership of PNR gave them direct, controlling influence over essential energy transportation, infrastructure, the very foundation of American industrial development. The success of the PNR acquisition established the core strategic template that would define Lehman Brothers for the next century. Identify strategic industries during periods of maximum crisis, acquire controlling positions at rock-bottom distress prices, and use that ownership leverage to fundamentally influence the market structure in ways that generate overwhelming, long-term competitive advantages. Their next strategic target was even more ambitious: the entire commodity trading infrastructure connecting American agricultural output to burgeoning global food markets. The brothers correctly identified that mass industrialization and explosive urbanization were creating unprecedented, consistent demand for processed food products. Yet the financial mechanisms for managing agricultural commodities remained technologically primitive and highly inefficient. In 1878, they established the Lehman Brothers Commodities Exchange, the first highly organized market dedicated to the trading of standardized agricultural futures contracts in New York. This venture was far more than a simple trading operation. It was a deliberate attempt to create the foundational financial infrastructure that would ultimately control how American food was priced, distributed, and financed worldwide. The exchange initially focused on cotton futures, leveraging the brothers' historical expertise and network, but they quickly expanded to encompass standardized contracts for wheat, corn, soybeans, cattle, and other key agricultural products, rapidly becoming homogenized commodities in the industrializing economy. What made their commodities exchange truly revolutionary was not the products traded, but the advanced financial instruments they engineered to facilitate transactions. They developed standardized contracts that precisely specified quality, delivery logistics, and settlement procedures. They established rigorous margin requirements, enabling traders to control vast commodity positions with relatively modest capital outlay. Crucially, they developed central clearing mechanisms that guaranteed contract performance even if individual traders defaulted, instilling essential confidence in the volatile market. These innovations transformed agricultural commodities from simple, localized buy-sell arrangements into sophisticated financial instruments utilized for hedging, speculation, and systematic risk management. Farmers could lock in prices for their crops months before harvest, significantly reducing their exposure to market volatility. Food processors could secure long-term supply contracts, enabling superior production planning. Investors could profitably speculate on commodity price movements without ever needing to take physical delivery of bulk agricultural products. The Lehman Brothers Commodities Exchange generated profits through transaction fees, margin interest, and market-making operations. But more importantly, it conferred upon them a powerful, systemic influence over food pricing that extended far beyond their own direct trading activities. Any company seeking to hedge agricultural risk or speculate on price movements required access to their exchange, creating dependency relationships that massively reinforced their market power. By 1880, Lehman Brothers controlled approximately 30% of all agricultural commodity trading executed in New York and had established crucial subsidiary operations in Chicago, New Orleans, and San Francisco. Their commodities exchange had become the nation's primary price discovery mechanism for American agricultural output, meaning the vast majority of food prices across the country were directly influenced by trading activities executed on their platforms. Perhaps their most significant achievement was the establishment of their firm as the essential, indispensable intermediary in the critical relationship between Wall Street finance and American agriculture. Farmers, food processors, agricultural equipment manufacturers, and global commodity traders all depended upon Lehman Brothers for market access, operational credit, and sophisticated risk management tools. This sophisticated agricultural finance infrastructure would prove critical as America transitioned from a predominantly rural economy into an industrial superpower. The brothers had positioned themselves to profit from every stage of that transformation, accumulating the capital reserves and political influence necessary to compete successfully with the most established old money Wall Street firms. By 1885, a mere 2 decades after their calculated retreat from Alabama, Lehman Brothers had ascended to become one of the most powerful and feared financial institutions in America. They had survived the worst economic crisis in the nation's history, acquired controlling interests in strategic transportation and commodity infrastructure, and firmly established themselves as innovative pioneers in both investment banking and commodity trading. Yet, they were about to discover that dominating the American domestic markets was only the preliminary step. The true, unprecedented opportunities lay in global expansion, international finance, and cultivating the kind of worldwide influence capable of systematically reshaping entire national economies. The former cotton merchants from Alabama were ready to evolve into global financial power brokers. By 1890, the Lehman Brothers had achieved something truly unprecedented in American finance. They possessed critical, controlling influence over essential infrastructure in 3 separate industrial sectors, vital to the nation's economy. Their railroad investments afforded them systemic influence over transportation. Their commodities exchange dominated agricultural trading, and their investment banking operations had become indispensable to corporate financing throughout the industrializing country. However, Henry, Emmanuel, and Mayer understood that mere individual industry dominance was negligible compared to comprehensive systemic control. Their ultimate goal was to build not just a successful business, but a financial institution so deeply and inextricably embedded in America's economic and monetary structure that the country could not literally function without their direct involvement. Their opportunity to achieve this systemic status emerged from an unexpected source: the federal government's determined effort to establish the nation's first unified, standardized national currency system. For decades, American money had been a chaotic mess, with hundreds of different private and state banks issuing their own heterogeneous currency notes that traded at wildly fluctuating values, depending on the reputation and financial stability of the issuing institution. While the National Currency Act of 1863 had initiated efforts towards standardization, implementation remained frustratingly inconsistent and riddled with logistical problems. Treasury Secretary John Sherman approached Lehman Brothers in early 1890 with a proposal that promised to transform the firm from a private investment house into a quasi-governmental financial agent. The Treasury urgently required private banks to assist in managing massive government bond sales, the intricate logistics of currency distribution, and the complex international exchange operations functions that exceeded the administrative capacity of the federal agencies themselves. This represented the ultimate opportunity the brothers had coveted: official recognition as essential, non-negotiable partners in managing the American monetary system. Yet, this elevated role demanded capabilities the firm did not yet fully possess: expansive international banking relationships, deep foreign exchange expertise, and massive capital reserves necessary to handle transactions on a government scale. Their solution was characteristically aggressive and swift. Instead of trying to slowly develop these capacities organically, They acquired them wholesale by purchasing 3 established financial institutions that already possessed precisely what they needed. First, they acquired a controlling interest in Hallgarten and Company, a respected German-American investment bank with extensive existing European connections and sophisticated foreign exchange operations. This acquisition instantly granted them direct, working access to the financial markets of London, Frankfurt, and Paris markets that were crucial for distributing large-scale government bond issuances internationally. Second, they purchased the private banking operations specializing in government finance from Kuhn, Loeb and Company. This acquisition secured their expertise in treasury bond underwriting and distribution, specialized knowledge that had been honed during the Civil War financing operations. This gave them the technical, operational knowledge needed to efficiently manage large-scale government securities transactions. Third, they acquired the International Banking Corporation, a specialized institution that managed currency exchange and international payments for American companies conducting business overseas. This provided the necessary infrastructure to manage the Treasury's foreign exchange operations and oversee international debt payments. These 3 strategic acquisitions, executed between 1890 and 1892, cost approximately $7 million, an enormous sum that represented the vast majority of Lehman Brothers' accumulated capital. But the result was transformative. The firm evolved almost overnight from a highly successful regional bank into a global financial institution, possessing operational capabilities that now rivaled the most established and powerful Wall Street houses. The timing of this consolidation proved flawless. Treasury Secretary Sherman's currency standardization program necessitated massive gold-backed bond sales to provide adequate reserves for the new national currency system. European investors were the primary target market for these bonds, as American investors simply did not possess the collective capital to absorb the entire issuance. Lehman Brothers' unique combination of intimate domestic market knowledge and deep-seated European relationships made them the ideal, irreplaceable intermediary for these complex transactions. They could price the bonds precisely to meet American fiscal requirements while structuring the terms attractively enough to satisfy the demands of skeptical European investors. Crucially, their proprietary expertise in agricultural commodity flows helped them understand exactly how currency stability would impact international trade balances. Their first major treasury contract involved the successful sale of $50 million in gold-backed bonds to European investors amidst the devastating economic crisis of 1893. This operation was a monumental endeavor, necessitating tight coordination across 4 competing financial capitals: London, Frankfurt, Amsterdam, and Paris, all while maintaining a shield of intense secrecy. The slightest leak could have triggered devastating market speculation and compromised the entire Treasury effort. The bond sale proved a spectacular triumph, securing the full $50 million within a mere 6 weeks and, crucially, solidifying international faith in the stability of American currency. Yet, the true paradigm shift went beyond the raw financial victory. It lay in the precedent they had established. They had proven themselves indispensable partners to the government. Treasury officials quickly understood that the capabilities Lehman Brothers possessed were unique and virtually impossible for other banking institutions to replicate overnight. Their deep-rooted expertise in agricultural commodities provided them with prescient knowledge of how currency policies would ripple across farming regions and export markets. Their strategic investments in the burgeoning railroad networks offered unparalleled visibility into transportation logistics, industrial supply chains, and infrastructure impacts. Furthermore, their carefully cultivated international relationships gave them the agility to manage foreign exchange operations, a requirement absolutely critical for modern governmental financing. Over the ensuing decade, Lehman Brothers cemented its role as the Treasury's primary private banking partner for all complex international financial operations. They seamlessly managed currency exchanges required for government payments overseas, coordinated monetary policy strategies directly with foreign central banks, and even functioned as unofficial diplomatic intermediaries when complex financial disputes arose between the United States and other global powers. This semi-official status provided more than immense direct profits derived from lucrative government contracts. It bestowed upon them advanced, proprietary knowledge of policy changes that were guaranteed to reshape financial markets. They possessed actionable intelligence regarding currency interventions before they were initiated, massive infrastructure spending plans before public announcement, and regulatory shifts before implementation. This informational supremacy was gold in their private trading operations. They could strategically position their own assets to capitalize on anticipated policy movements, while expertly guiding their most valued clients through the swiftly changing regulatory landscape. They became the essential intelligence source for businesses across the country, seeking clarity on governmental financial directives. But perhaps their most significant, lasting innovation was the concept they perfected: integrated relationship banking. This was a holistic system where a single client would receive investment banking, specialized commodity trading, transportation financing, and critical government relations services, all delivered by different Lehman Brothers divisions that shared information, cross-coordinated strategies, and moved with unified purpose. This approach intentionally forged relationships built on powerful mutual dependency. Once a major corporation engaged Lehman Brothers for one critical service, they quickly recognized the profound advantages of consolidating all their financial requirements with the same institution. The brothers could offer superior pricing, develop more sophisticated risk management programs, and provide market intelligence that competitors simply could not match because they controlled all facets of the client's financial ecosystem. By 1900, Lehman Brothers had established these integrated bonds with more than 200 of the largest American corporations, including the vast majority of the country's major railroad conglomerates, agricultural processors, and industrial manufacturing giants. These relationships ensured a steady stream of fee income, simultaneously generating the information and influence necessary to identify and finance the next wave of massive investment opportunities. The brothers had achieved what would become the defining core of Lehman Brothers' competitive strategy for the next 100 years. They had woven themselves so deeply and indispensably into the operational fabric of American economic activity that their own success was inextricably linked to the success of the entire nation. When American businesses prospered, Lehman Brothers automatically captured a percentage of that prosperity through their interconnected service relationships. When government policies shifted, they profited both from their advanced knowledge and by helping their clients adapt swiftly. When entirely new industries emerged, they were prepared with the required capital and specialized expertise to finance that development, often securing commanding positions for themselves in the process. They had executed a complete transformation, graduating from humble Alabama cotton merchants to the essential, complex financial intermediaries of modern American capitalism. Yet, they were poised to realize that domestic American dominance was merely a launching pad for far grander ambitions. The true, boundless opportunities lay in global expansion and constructing the kind of international financial power capable of influencing and shaping entire nations. The dawn of the 20th century would serve as the ultimate crucible, testing whether the ruthlessness and radical adaptability forged in Alabama could successfully operate on the unforgiving world stage. The assassination of Archduke Franz Ferdinand on June 28, 1914, did not register as a tragedy for Lehman Brothers. It was heralded as the single greatest financial opportunity in the firm's 70-year history. While the majority of American business viewed the brewing European conflict as a remote, unfortunate political development, the brothers immediately recognized that World War I would necessitate unprecedented levels of financing and unleash profit opportunities that dwarfed anything they had ever conceived. More critically, they understood that whichever institution successfully positioned itself as the essential financial intermediary during the conflict would emerge with a global influence powerful enough to permanently reshape international capitalism. The Lehman Brothers were determined to leverage the collective European self-destruction to establish themselves as one of the world's most formidable financial institutions. Their resulting strategy was characteristically calculated, brilliant, and completely amoral. they planned to finance all sides of the conflict while rigorously maintaining an official posture of neutrality, thereby ensuring maximum profit, regardless of which nations ultimately triumphed or fell. This approach demanded extraordinary diplomatic finesse and continuous financial innovation, but it offered the potential for gains that could eclipse their entire accumulated fortune. Within weeks of the war's opening salvos, Emanuel Lehman had initiated confidential negotiations with French, German, British, and Russian financial representatives. Each government was desperately seeking American credit to secure military equipment, food supplies, and the raw industrial materials their own wartime economies could no longer provide. Traditional international lending involved government-to-government agreements, which entailed time-consuming congressional approval and political oversight, all elements the brothers wished to avoid. Instead, they masterminded a complex network of private financing arrangements meticulously structured to appear as standard commercial transactions, but which, in reality, provided crucial war funding to the European combatants. Here was the architectural ingenuity of their system. European governments established shell purchasing agencies in New York, designed to look like private companies buying American goods strictly for civilian use. These agencies would then secure financing from Lehman Brothers to purchase massive volumes of wheat, steel, chemicals, and other fungible materials that could be rapidly converted for either civilian or military purposes. The key in innovation lay in creating financial instruments that technically skirted the constraints of American neutrality laws, while simultaneously enabling massive military capital flows. Rather than directly lending funds to hostile foreign governments, Lehman Brothers was simply providing commercial credit to private, third-party companies that just happened to be entirely controlled by those governments. This ingenious system generated astronomical profits across multiple layers. They earned substantial arrangement fees for structuring the financing, collected high interest on the loans themselves, and realized massive trading profits from the corresponding commodity transactions. Even more valuable, they accumulated precise, granular intelligence regarding each country's remaining financial resources, their critical military needs, and their strategic vulnerabilities data that proved invaluable for their long-term planning and subsequent investments. By 1916, Lehman Brothers was facilitating approximately $200 million annually in war-related financing, a figure roughly equivalent to $5 billion in today's terms. Their operations had expanded to include dedicated offices in London, Paris, Berlin, and St. Petersburg, making them one of the very first American financial institutions with truly global, on-the-ground reach. But their most audacious strategic maneuver occurred when the United States formally entered the war in April 1917. While competitor banks worried that American participation would force them to abandon their profitable neutrality and choose sides, the Lehmans saw a colossal opportunity to become the primary financial intermediary for the entire American war effort. They leveraged their established, deep European relationships to assist the U.S. Treasury in coordinating Allied financing strategies. They employed their sophisticated commodity trading infrastructure to manage the complex supply chain for food and materials destined for American troops overseas. They utilized their international banking network to simultaneously handle currency exchange and payment operations across multiple allied countries. This semi-official capacity, as the Treasury's international operations partner, generated immense profits from direct government contracts. Far more importantly, it positioned Lehman Brothers as essential facilitators of the eventual Allied victory, granting them significant influence over the planning for post-war economic reconstruction. When the armistice arrived in November 1918, the brothers had accumulated more wealth than at any prior point in their history. Yet, they had also acquired something immeasurably more powerful: entrenched relationships with key government officials and financial institutions spanning both Europe and America. The perfect foundation for dominating international finance during the peace. The Treaty of Versailles immediately created unprecedented opportunities for international banking expertise. Germany was saddled with massive reparation payments to the victorious Allied nations. European currencies were in chaotic need of stabilization following years of severe wartime inflation. Entire regions required infrastructure reconstruction projects that would span decades and cost tens of billions of dollars. Lehman Brothers strategically positioned themselves as the essential intermediary for managing these complex, transnational financial flows. They played a core role in structuring Germany's reparations payments to mitigate economic disruption while ensuring predictable revenue streams for Allied recipients. They engineered innovative currency stabilization programs that quickly restored international trade relationships. Crucially, they organized the reconstruction financing that rebuilt decimated European infrastructure, generating substantial, secure profits for American investors in the process. But perhaps their most defining achievement of this era was the establishment of what they dubbed global relationship banking, an integrated, seamless network of international subsidiaries capable of providing the most sophisticated financial services in any major world economy. By 1925, Lehman Brothers maintained permanent, fully staffed offices in 12 different countries and upheld active correspondent relationships with banks in over 30 nations. This vast international network allowed them to facilitate colossal cross-border transactions that other purely domestic American banks couldn't even contemplate, providing their clients with global capabilities that often exceeded what most national governments could offer. Their London office specialized in European government finance and intricate currency operations. Their Paris subsidiary handled continental trade financing and commodity transactions. Their Berlin office managed German industrial reconstruction financing and the implementation of reparations payments. New offices in Sao Paulo, Buenos Aires, and Mexico City provided crucial access to fast-growing Latin American commodity markets and government financing opportunities. This global infrastructure generated steady profits from traditional banking services, like complex loans and currency exchange. More significantly, it granted them access to unique investment opportunities and deep market intelligence entirely unavailable to purely domestic firms. They could identify industrial development projects in emerging markets long before other investors were aware of their existence. They could anticipate currency devaluations and major commodity price movements by tracking political and economic developments across dozens of countries simultaneously. They specialized in structuring convoluted international transactions that demanded deep expertise across multiple legal and regulatory systems. The brothers had achieved something unprecedented. They had forged a financial institution that operated as effectively and ruthlessly in international markets as it did in its core American domestic markets. This truly global capability would prove absolutely crucial as major American corporations began expanding overseas and foreign governments sought reliable access to American capital markets. However, their explosive international expansion had also created profound, new vulnerabilities that they did not yet fully grasp. Their extensive global network necessitated the maintenance of high-stakes relationships with political leaders whose stability could not be guaranteed. Their massive international investments were exposed to volatile currency risks and geopolitical developments completely beyond their direct control, and their rapid, overwhelming success had begun to attract intense scrutiny from powerful competitors and government officials who viewed their pervasive influence with deep suspicion. The very global reach that had propelled them to become one of the most powerful financial institutions in the world would now expose them to risks and opportunities that would test their survival instincts. Once again, their status as a quasi-governmental agent granted Lehman Brothers a panoramic view of the American economic engine. Throughout the first 2 decades of the 20th century, they did more than just accumulate wealth. They learned to read the early tremors of market euphoria. While the Roaring Twenties sent the world into a speculative frenzy, the Lehmans sensed the instability lurking beneath the gilded surface. With the cold-blooded sobriety of survivors who had weathered multiple wars, they began retreating into the shadows, waiting for the inevitable end of the great financial party. The stock market crash of October 29, 1929. Black Tuesday destroyed more accumulated wealth in a single catastrophic day than most countries had amassed in their entire histories. Within a few frantic hours, panic selling obliterated $25 billion in market value, equivalent to approximately $400 billion in contemporary terms. Most Wall Street firms watched helplessly as their clients' fortunes evaporated and their own corporate survival dissolved into uncertainty. Lehman Brothers, however, earned more profit on Black Tuesday than they had accrued on any single day in their preceding 85-year history. Their secret was not superior market analysis or unethical insider information. Their secret was the same relentless contrarian approach they had deployed during the Panic of 1873, the Spanish-American War, and World War I. When everyone else was consumed by paralyzing panic, they were meticulously calculating. When others were forced to liquidate, they were aggressively buying. When conventional wisdom screamed that the economic world was ending, they were strategically positioning themselves to profit from whatever future emerged. The brothers had anticipated the crash for months. Mayor Lehman, though now in his 70s, still possessed an uncanny, almost supernatural market timing ability and had been quietly, systematically liquidating speculative positions and accumulating massive cash reserves throughout 1929. By October, Lehman Brothers controlled over $50 million in immediately available capital, an enormous sum representing the vast, disciplined profits accumulated over 60 years of conservative financial management. When the panic began, they implemented a strategic response that was breathtaking in its audacity and scope. Instead of scrambling to protect their remaining existing investments, they began purchasing distressed assets from desperate, fleeing sellers at fractions of their pre-crash values. Instead of aggressively calling in outstanding loans to hoard capital, they extended additional, vital credit to corporations they had carefully identified as possessing the fundamental strength to survive the inevitable economic devastation. Their shopping list during the weeks of the crash was extraordinary, controlling interests in 3 major, distressed railroad companies, substantial positions in key steel and automotive manufacturers, entire portfolios of high-quality government and corporate bonds, and prime real estate properties throughout Manhattan that panicked investors were abandoning for immediate liquidity. But their most strategically significant acquisition surprised even veteran Wall Street observers. They purchased the failing brokerage operations, client lists, and institutional infrastructure of 7 smaller investment banks, instantly and dramatically expanding their client base and market presence while eliminating competitors who might have posed a threat during the recovery. This acquisition strategy required not only extraordinary financial discipline, but also radical psychological fortitude. The brothers were making colossal financial bets at a time when most observers believed the American economy was collapsing permanently. They were committing their accumulated dynastic wealth to investments that risked proving utterly worthless if the entire economic system actually failed. Their profound confidence was rooted in a sophisticated, systemic analysis that others had missed. While stock prices had plummeted into the abyss, the fundamental productive capacity of American industry remained fundamentally intact. Factories still stood ready, transportation networks still functioned, and consumer demand, though temporarily reduced, still fundamentally existed. More importantly, they recognized that the federal government would inevitably intervene to prevent complete systemic collapse. The political consequences of a permanent depression were simply unacceptable to any democratic government, meaning that massive fiscal and monetary stimulus was inevitable, even if politicians had not yet publicly acknowledged that reality. When Franklin Roosevelt was elected in 1932 and immediately began implementing the aggressive New Deal programs, Lehman Brothers was perfectly positioned to profit from every element of government intervention in the economy. Their railroad investments surged in value thanks to federal infrastructure spending programs. Their industrial holdings gained momentum from manufacturing recovery initiatives and government contracts. Their real estate properties dramatically appreciated as federal housing programs stabilized urban markets. Most critically, their expanded brokerage operations captured enormous trading volumes as cautious investors gradually returned to the financial markets during the mid-1930s recovery. While competitor Wall Street firms were still struggling merely to rebuild their depleted client bases, Lehman Brothers was handling more daily transactions than they had managed before the crash even began. The brothers utilized their massive Depression-era profits To fund the most ambitious internal expansion in the company's history, they established critical new offices in Los Angeles, Dallas, Atlanta, and Miami, strategically positioning themselves to capture business from America's rapidly growing Sunbelt regions. They created specialized divisions focused on emerging, high-growth industries like aviation, electronics, and petroleum sectors destined to dominate the post-war economy. More significantly, they began developing the pioneering financial innovations that would come to define modern investment banking. They spearheaded the development of leveraged buyout LBO structures, which allowed companies to acquire competitors using large amounts of borrowed money. They created complex derivative instruments that enabled investors to speculate on minute market movements without ever owning the underlying assets. And they developed securitization techniques that transformed illiquid, static assets, such as residential mortgages, into tradable, exchangeable securities. These innovations were not merely profitable. They fundamentally altered the way American capitalism functioned. Companies that once relied solely on retained earnings for slow, internal expansion could now access volatile capital markets for rapid, exponential growth financing. Investors who once only bought individual stocks and bonds could now purchase sophisticated instruments that provided leveraged exposure to entire market sectors or macroeconomic trends. By 1940, Lehman Brothers had evolved from a traditional investment bank into something truly unprecedented, a financial institution that actively created new types of economic relationships rather than simply facilitating existing ones. They weren't just helping companies raise capital, they were fundamentally inventing new ways for capital itself to be organized, deployed, and multiplied. World War II provided the ultimate test of their expansive global capabilities. As the United States transformed into the acknowledged arsenal of democracy, Lehman Brothers expertly coordinated the financing for massive military production programs while simultaneously managing the volatile international financial relationships with allied governments. Their wartime operations dwarfed their involvement in World War I. They arranged over $2 billion in crucial war production financing, managed currency exchange for military operations across dozens of countries, and coordinated with foreign central banks to stabilize international monetary systems under intense pressure. But their most significant wartime innovation was the creation of what they termed post-war reconstruction planning. Detailed, comprehensive financial strategies for rebuilding the economies of Europe and Asia once military victory was secured. These far-sighted plans positioned Lehman Brothers as essential partners in creating the entire international economic order that would emerge from the Allied triumph. When the war concluded in 1940, the brothers had accumulated influence that extended far beyond the traditional scope of banking. They were central advisors to government officials planning the foundational Bretton Woods monetary system. They served as consultants to military administrators managing occupied territories. They were embedded partners with nascent international organizations like the World Bank and the International Monetary Fund, institutions that would govern global finance for decades. The Lehman Brothers firm of 1945 bore almost no resemblance to the Alabama cotton merchants of 1844. They commanded a sophisticated financial empire that spanned continents and directly influenced the economic policies of multiple sovereign governments. They had survived and spectacularly profited from every major crisis of the previous century, accumulating unique capabilities that made them indispensable to the functioning of modern international capitalism. But they had also inadvertently created something profoundly dangerous, a financial institution so enormous, so complex, and so deeply interconnected that its failure could potentially threaten the stability of the entire global economy. The same intense risk-taking appetite that had enabled their spectacular growth had also made them fundamentally dependent on continuous expansion and ever-increasing leverage to maintain their towering profit margins. The post-war world offered unprecedented opportunities for global financial institutions with their innovative, predatory approach, but it would also introduce systemic risks and challenges that would ultimately test whether the Lehman Brothers' Alabama-forged adaptability could continue operating successfully in an increasingly complex and dangerously interconnected world. By 1975, a fundamental, insidious cultural shift had taken root at Lehman Brothers. The meticulous risk management discipline that had enabled the firm to survive and profit through every crisis since 1844 was being replaced by an increasingly reckless, even avaricious, appetite for profit that relentlessly prioritized astronomical short-term gains over the long-term stability of the institution itself. The warning signs of this internal decay were manifest. Yet the firm's leadership was so intoxicated by continuous success and unparalleled profit that they failed entirely to recognize the systemic dangers they were actively engineering. This profound transformation began with the arrival of Louis Glucksman in 1967, a brilliant but ruthlessly aggressive trader who perfectly embodied a new, more cynical generation of Wall Street executives. Unlike the original Lehman family members who had built the firm through patient relationship banking and conservative risk management, Glucksman vehemently believed that maximizing profits demanded maximizing risk-taking, viewing traditional caution as an incompatible handicap in modern financial markets. Under Glucksman's powerful influence, Lehman Brothers began to pursue what he bluntly termed accelerated profit strategies, which involved drastically increasing the firm's leverage and aggressively expanding into high-risk, high-reward proprietary trading activities. The firm's debt-to-equity ratio, which had never exceeded a cautious an 8-to-1 ratio during the previous century, violently surged to a 15-to-1 ratio by 1975 and would continue its upward, dangerous climb throughout the following decades. This unprecedented multiplication of leverage was made possible by revolutionary financial innovations that permitted investment banks to borrow enormous amounts of money using their vast trading inventories as collateral. Instead of financing operations primarily through stable client deposits and safely retained earnings, Lehman Brothers began funding its rapid expansion through complex repurchase agreements repos, exotic derivatives contracts, and opaque off-balance sheet vehicles designed specifically to obscure the true, volatile extent of their financial obligations. The immediate results were financially spectacular. Lehman's annual profits skyrocketed from $25 million in 1970 to over $100 million by 1975, instantly ranking it among the most profitable investment banks on Wall Street. Glucksman's new trading operations consistently generated returns that often exceeded 30% annually, attracting intense admiration from competitors and breathless financial media coverage that hailed the firm as the definitive model of modern financial innovation. But hidden beneath the impressive headline profit numbers, fundamental and ultimately fatal problems were developing. The dramatically increased leverage meant that relatively small, localized trading losses could have instantly catastrophic effects on the firm's entire capital position. The complex, non-transparent funding arrangements created dangerous dependencies on fragile, short-term financing markets that could vanish entirely during periods of acute financial stress. Furthermore, the firm's obsessive focus on immediate trading profits was slowly, fatally eroding the foundational client relationship banking model that had sustained Lehman's success for over a century. Perhaps most dangerously, the firm's internal risk management systems had failed to evolve to match the complexity and scale of their hyper-aggressive new trading operations. Risk controls that had been perfectly adequate for traditional, conservative investment banking were utterly insufficient for managing the exotic derivatives, high-frequency arbitrage, and proprietary trading strategies that were now generating the vast majority of the firm's profits. The first truly serious warning came during the 1970s oil crisis, when Lehman Brothers suffered debilitating losses on energy derivatives trades that had been designed under the flawed assumption of stable petroleum prices. The firm hemorrhaged over $40 million in a single quarter, equivalent to roughly $200 million today, and came perilously close to violating crucial regulatory capital requirements. Instead of using this near-fatal miss as an urgent opportunity to reassess their underlying risk management practices and reduce leverage, firm leadership, driven by Glucksman, doubled down on high-risk strategies. They hired additional Even more aggressive traders dramatically expanded their derivatives operations and began taking even larger speculative positions in highly volatile commodity and currency markets. The underlying rationalization was seductive. If their trading strategies could reliably generate 30% annual returns, then occasional, temporary losses were simply accepted as the unavoidable cost of doing aggressive business. Complex mathematical models suggested that the probability of catastrophic losses was statistically minimal, and the firm's long historical track record seemed to validate their overwhelming confidence in their ability to navigate and manage financial risks. But the models contained a crucial, fatal flaw. They were based on historical market data that simply did not account for the systemic, interconnected risks being created by the very financial innovations they themselves were employing. The same combinations of leverage and complex derivative strategies that enabled spectacular profits also created the potential for losses that could rapidly exceed the firm's entire capital base. More ominously, Lehman Brothers was no longer alone in this dangerous pursuit. Across the whole of Wall Street, investment banks were aggressively increasing leverage, massively expanding derivatives trading, and developing increasingly complex financial instruments that concentrated systemic risk in ways that individual institutions could no longer fully understand or measure. The 1980s accelerated these dramatic changes as widespread financial deregulation eliminated many of the historical constraints that had successfully limited investment bank risk-taking since the Great Depression. The Glass-Steagall Act, which had legally separated commercial and investment banking since 1933, was systematically weakened through strategic regulatory reinterpretations and subsequent legislative changes. Lehman Brothers eagerly exploited this deregulation to aggressively expand into commercial banking activities that had been strictly prohibited since the 1930s. They began making direct, risky loans to massive corporations and speculative real estate developers, while simultaneously underwriting securities offerings for those very same clients. This created potential conflicts of interest that were impossible to manage effectively and dangerously increased their simultaneous exposure to multiple, uncorrelated types of financial risk. The firm's leadership convinced themselves that their sophisticated, self-developed risk management techniques could handle these challenges. They poured capital into developing complex mathematical models for precisely measuring and mitigating risk across their various business lines. They hired teams of PhD economists and mathematicians to analyze market trends and identify subtle profit opportunities, but the models still contained that fatal flaw. They assumed financial markets would continue behaving according to historical patterns that were already being fundamentally disrupted and invalidated by the very innovations the models were designed to manage. The exponential increase in leverage, the complexity of derivatives, and the interconnected risk exposures were creating systemic vulnerabilities that historical data simply could not capture. The 1987 stock market crash. Black Monday provided yet another terrifying warning that went utterly unheeded. On October 19th, the Dow Jones Industrial Average plummeted 22% in a single day, marking the largest single-day percentage decline in stock market history. Lehman Brothers lost over $100 million in a matter of hours as their complex, automated trading strategies collapsed simultaneously. The firm survived the immediate crisis because the Federal Reserve intervened decisively to prevent a complete systemic collapse, and because Lehman's diversified operations still generated sufficient underlying cash flow to absorb the massive trading losses. But the crash unequivocally demonstrated how quickly and completely their supposedly sophisticated risk management systems could fail when market conditions exceeded historical precedents. Once again, instead of using the crisis to fundamentally reassess their high-risk strategies, Lehman's leadership concluded they simply needed better models and more sophisticated trading techniques. They dramatically increased their investment in quantitative analysis and began developing even more complex derivative strategies that they fully believed would generate higher returns with mathematically lower perceived risk. By 1990, Lehman Brothers had mutated into something that would have been utterly unrecognizable to its 19th century founders, a highly leveraged, technology-dependent, model-driven institution that bore little resemblance to the relationship-focused, cautious investment bank that had successfully navigated every crisis since the Civil War. But how did a relationship-focused bank transform into a model-driven gambling house? The missing link was 1999. The repeal of the Glass-Steagall Act forged the way for new, volatile investment practices, allowing Lehman to combine commercial banking with high-stakes securities. This deregulation was the oxygen that fed the subprime fire, forcing Lehman to compete with giants like Citigroup and JP Morgan by taking risks that were previously illegal. The firm's dazzling success had cultivated a dangerous and deep-seated overconfidence that tragically blinded its leadership to the systemic risks they were actively, continuously creating. The genesis of the firm's destruction can be traced back to a pivotal meeting held on March 15, 2005, within the newly consecrated halls of 745 7th Avenue, a veritable temple of finance, shimmering with hubris. CEO Richard Fuld, often referred to internally by the nickname the Gorilla for his imposing, stubborn demeanor, addressed the firm's executive committee. He unveiled a strategy promising exponential profits, yet concurrently embedding the existential vulnerabilities that would ultimately fell the 158-year-old titan, a massive, leveraged expansion into subprime mortgage securities. Fuld's presentation was not merely compelling, it was seductive. It hinged on the seemingly unimpeachable logic that American housing prices had risen consistently for generations, establishing real estate as a bedrock investment capable of delivering superior, risk-adjusted returns, mortgage-backed securities. MBS allowed the firm to capitalize on this boom while theoretically distributing risk across a vast portfolio of individual loans. Furthermore, novel financial engineering allowed them to create complex derivative instruments capable of multiplying those underlying profits exponentially. What Fuld conveniently omitted, or perhaps tragically failed to grasp, was that Lehman Brothers was preparing to wager its entire legacy on a colossal financial bubble. This strategic pivot flagrantly violated every tenet of sound, century-old risk management that had allowed the firm to survive the Civil War, the Great Depression, and countless panics. The subprime mortgage strategy was the perfect embodiment of everything corrupt and ill-conceived about the modern Lehman Brothers. Instead of painstakingly scrutinizing credit risk, as their predecessors had done when vetting cotton traders or funding nascent railroad barons, they relied exclusively on sophisticated mathematical models predicated on the dangerously naive assumption that housing values could never suffer a meaningful decline. Instead of nurturing diversified, resilient revenue streams, they concentrated enormous pools of capital into a singular, highly correlated asset class. Instead of adhering to conservative leverage limits, they financed their explosive growth with catastrophic levels of debt. The mechanism of this seductive strategy was deceptively simple. Lehman Brothers would purchase high-risk mortgages loans originated by other banks to borrowers with dubious credit histories or minimal documentation. The ninja loans, no income, no job, no assets. They would then pool these high-risk mortgages into complex, multi-layered securities known as collateralized debt obligations, CDOs, which gave the superficial appearance of reduced risk through structural diversification. These CDOs were sold to institutional investors while Lehman retained significant, risky tranches for its own proprietary trading accounts. But the true fortune lay in the derivatives superstructure built atop this market. Lehman innovated synthetic CDO, allowing investors to place massive speculative bets on mortgage performance without actually owning any physical loans. They aggressively developed credit default swaps, CDS, functioning essentially as unregulated insurance policies on mortgage securities. They engineered complex high-velocity arbitrage strategies that could mint profits in multiple market conditions, irrespective of whether housing prices were inching up or accelerating down. These instruments were hyper-profitable as long as the housing escalator moved upward and default rates remained benign. As Fuld and his team gambled the firm's 158-year history, they had long forgotten the modest integrity of family members like Herbert Lehman. While the modern firm prioritized maximum extraction, Herbert's legacy in education and social justice reminds us that the health of a market depends not on algorithms, but on the character of those who wield power. Lehman's mortgage-related revenues skyrocketed from a respectable $500 million in 2002 to an astonishing $4 billion by 2006, momentarily crowning it the most lucrative division in the firm's history. Yet, this strategy housed fatal, fundamental flaws that any student of financial history should have instantly identified. The firm was placing an existential wager that the laws of economic gravity had been repealed, betting that housing prices would rise eternally, contrary to all historical evidence that every asset bubble inevitably bursts. They leveraged their exposure to this single asset class with staggering amounts of borrowed money, utterly betraying basic portfolio diversification. Crucially, they were weaving together derivative exposures of such unprecedented complexity that accurately calculating the firm's total systemic risk became functionally impossible. Perhaps most perilously, Lehman's staggering, short-term success became a magnet for imitators across Wall Street. Bear Stearns, Merrill Lynch, Goldman Sachs, and other major investment banks began pursuing similar, leverage-fueled subprime strategies, thereby creating a dangerous, systemic contagion that extended far beyond the walls of any single institution. The initial tremors began in early 2006. Mortgage default rates ticked upward, and the blistering pace of housing appreciation began to falter in several key metropolitan markets. Traditional risk management would have dictated a rapid and aggressive reduction of exposure and preparation for substantial losses. Instead, Lehman's leadership, fueled by overconfidence and a refusal to concede error, decided to double down. Their rationale, while internally coherent, was tragically flawed. If housing prices were temporarily softening, that merely presented an opportunity to scoop up distressed mortgage assets at bargain prices. If other, weaker firms were shrinking their mortgage desks, dominant jitter, Lehman could strategically gain market share by reaffirming its commitment to the sector. Throughout 2006 and well into 2007, as the housing market manifestly deteriorated, Lehman actually increased its mortgage holdings. They purchased additional subprime loans, dramatically expanded their CDO creation activities, and took larger, riskier proprietary trading positions in mortgage-related derivatives. This catastrophic decision was a product of corporate greed, unbridled overconfidence, and a stubborn reliance on quantitative mathematical models that were fundamentally incapable of factoring in systemic panic or human behavior. The firm's quantitative analysts continued to generate soothing reports, insisting that the probability of significant, coordinated housing price declines was minimal. Trading profits remained superficially strong as long as they could find institutions, often overseas banks, willing to purchase their increasingly questionable mortgage securities. Most dangerously, the firm's senior leadership had become so deeply invested in the strategy that admitting fundamental error would have necessitated a humiliating acknowledgement of profound failures in judgment. This refusal to pivot wasn't just a corporate strategy. It was a personal crusade led by a man who refused to blink in the face of a hurricane. Richard Fuld, known as the Gorilla, operated with a bunker mentality. He chose to double down on toxic assets while the world was screaming for caution. It was hubris, the fatal belief that they were too big to fail. This arrogance blinded him to the reality that in a global panic, no fortress is impregnable. This obsession with growth led to a ruthless internal purge. The downfall was preceded by an internal war where Michael Gelband, head of fixed income, was fired for opposing the accumulation of risky assets, replaced by Roger Nagyoff, a man living in London with no direct experience in the US fixed income market. By early 2008, Lehman Brothers had amassed mortgage-related exposures exceeding $60 billion, roughly 4 times its total shareholder equity. Simple arithmetic meant that a mere 25% decline in the value of their mortgage portfolio would entirely obliterate the firm's capital base. However, the true scale of their vulnerability was far greater, obscured by complex derivative positions and shadowy off-balance sheet commitments that were nearly impossible to quantify accurately. The firm's own marginalized risk managers privately estimated that total mortgage exposure could surge past $100 billion under certain severe market scenarios when the housing bubble finally and inevitably burst in 2008. Lehman Brothers faced cataclysmic losses from which no financial institution could possibly recover. Its mortgage securities plummeted, losing 50% to 70% of their value within months. Its derivative positions triggered massive collateral demands from counterparties across the globe as contracts turned severely against the firm. Crucially, its essential funding sources vanished instantaneously as investors, smelling the blood in the water, lost all confidence in Lehman's ability to service its short-term obligations. The irony was savage and absolute. Lehman Brothers, the institution that had survived the Civil War, 2 world wars, the Great Depression, and countless localized crises through disciplined risk management and strategic adaptability, was being annihilated by the complete abandonment of the very principles that had sustained its historical success. Richard Fuld and his executive team had consciously jettisoned the essential wisdom learned by Henry, Emmanuel, and Mayer Lehman amidst the chaos of Alabama cotton fields. Sustainable success, they forgot, demands understanding and respecting risk, maintaining diversified exposure across multiple markets, and preserving sufficient financial flexibility to survive unexpected black swan events. Instead, they had chased a strategy that brutally concentrated massive risk in a single asset class, used extreme leverage to amplify their downside exposure, and established derivative obligations too complex and vast to effectively manage. They had mutated a once conservative, relationship-focused investment bank into a grotesquely leveraged hedge fund, utterly dependent on the continuous, unbroken upward trajectory of the U.S. housing market. The same unyielding appetite for profit maximization that had enabled the firm's founders to forge their initial fortune from the wealth generated by human enslavement had finally evolved into a reckless gambling addiction that would consume and destroy every element they had created. The firm that had demonstrated remarkable resilience and adaptability for over 150 years was about to prove that financial institutions, much like the flawed individuals who run them, can indeed be killed by the hubris of their own overwhelming success. This deep-seated overconfidence, fueled by the repeal of Glass-Steagall and a blind faith in mathematical models, led Lehman Brothers into its final and most fatal gamble, the subprime mortgage market. In the early 2000s, Richard Fuld transformed the firm into a relentless machine for mortgage-backed securities, vacuuming up high-risk home loans and repackaging them into glittering financial products. They ignored the laws of economic gravity, convinced that housing prices would rise indefinitely. But when the bubble finally burst in 2007, the 40-to-1 leverage that once generated record profits suddenly turned into a noose around the empire's neck. The stage was set for the most dramatic collapse in financial history in the autumn of 2008. September 10th, 2008, dawned like any other Tuesday on the 41st floor of 745 7th Avenue. Lehman Brothers senior executives arrived, expecting another grueling but ultimately manageable day in the relentless, ongoing financial crisis. Yet, by midnight, they would be frantically assembling bankruptcy documents for one of the most powerful and storied financial institutions the world had ever known. The velocity of Lehman's final collapse was breathtaking, defying even the accelerated timeline of a modern financial meltdown. On September 9th, the firm reported $639 billion in assets and maintained vital trading relationships with thousands of global clients. Less than 72 hours later, it would become the largest corporate bankruptcy in American history, triggering a global economic crisis that dwarfed anything seen since the 1930s. But the final demise had been brewing for months, as the mortgage-related losses metastasized and funding sources steadily withered. In May 2008, Senior VP Matthew Lee sent a desperate letter to management alleging accounting mismanagement, but he was simply laid off while the firm continued its reckless gamble. What transformed a severe but potentially survivable crisis into absolute institutional death was a succession of catastrophic decisions made during that final, fateful week, a series of missteps that demonstrated how completely Lehman's leadership had lost contact with the risk management fundamentals that had protected its predecessors through every prior historical upheaval. The week commenced with Lehman's stock already trading 80% below its 2007 peak. As investors had finally awakened to the terrifying reality, the firm's mortgage exposures were vastly larger and far more dangerous than management had publicly admitted. Nevertheless, CEO Richard Fuld and his inner circle maintained a delusional belief that survival was possible, provided they could secure an immediate injection of capital or engineer an emergency merger with a stronger partner. Their first lifeline attempt involved approaching Warren Buffett's Berkshire Hathaway for a potential investment. Buffett's reputation as the ultimate crisis investor made him an ideal, stabilizing partner. However, the subsequent negotiations starkly revealed the deep denial gripping Lehman's leadership. Buffett, ever shrewd, offered to inject $5 billion in preferred stock with a 9% dividend and significant equity participation, but only if Lehman simultaneously raised an equivalent $5 billion from other investors and agreed to realistically write down its toxic mortgage assets to their true market values. Given the accelerating danger, these terms were exceptionally generous. Yet Fuld, consumed by pride and a refusal to admit the true extent of the devaluation, rejected the offer as excessive and personally insulting. When survival was on the line, Richard Fuld's ego got in the way. He rejected a $5 billion investment offer from Warren Buffett because he deemed the conditions excessive and insulting, a mistake that lost Lehman its final stamp of credibility. The rejection of the Buffett offer was a calamitous strategic error, the ultimate testament to how arrogance and denial had irrevocably clouded the judgment of executives facing annihilation. Buffett's involvement would have provided not merely essential capital, but a priceless stamp of credibility that could have restored critical market confidence, potentially allowing the firm to weather the storm. Instead, Fuld wasted precious hours pursuing highly unrealistic negotiations with the Korea Development Bank, KDB, regarding a minority stake in Lehman's investment management unit. These peripheral discussions consumed critical time and focus that should have been dedicated to immediately actionable survival strategies. By Friday, September 12, the KDB negotiations had predictably failed to materialize fast enough. Lehman's funding situation had deteriorated so acutely that the firm was struggling to access the short-term commercial paper markets essential for its daily operations. The last remaining hope centered on securing an American corporate acquirer capable of executing a transaction over the ensuing weekend. Two plausible suitors emerged: Bank of America, Buffett, and Barclays. Both possessed the financial muscle to absorb Lehman's operations and the strategic desire to instantly expand their investment banking capabilities. The Bank of America talks were initially the most promising. CEO Ken Lewis, known for his aggressive expansionist strategies, viewed Lehman's distress as a unique opportunity to acquire premier investment banking talent at a fire sale price. Early discussions suggested a structure that could preserve the majority of Lehman's operations while injecting the desperately needed capital. However, Buffett's rapid due diligence process unearthed a situation far more dire than Lehman's public disclosures had suggested. The firm's mortgage exposures were larger, their complex derivative obligations more opaque, and their immediate funding requirements more severe than management had admitted. Even to potential saviors, more critically, Buffett discovered the mechanisms behind the mask. They used aggressive and deceptive accounting maneuvers, like Repo 105, to temporarily shuffle assets off the balance sheet and mask the true extent of their toxic exposure. By doing so, they had been creating a phantom stability that existed only on paper. Inside the firm, Repo 105 wasn't just a tactic. Employees privately mocked it as another drug we're on, and a lazy way of managing the balance sheet through legal window dressing. Once these cosmetic accounting adjustments were reversed, Lehman's true leverage ratio soared to exceed 40-to-1, a level that made bankruptcy a near certainty once funding markets seized up. On Saturday, September 13th, Bank of America abruptly terminated negotiations with Lehman. Instead, they announced they would acquire Merrill Lynch, which was facing similar but less catastrophic mortgage troubles. This decision sealed Lehman's fate, as no other potential American acquirer possessed the capacity to absorb the firm's massive, newly revealed obligations. The parallel Barclays negotiations continued throughout the weekend, but they encountered an insurmountable obstacle. British financial regulators refused to approve any transaction that would expose a major UK bank to Lehman's unknown and unquantifiable derivative liabilities without a detailed review process that would take weeks to complete. It was against this backdrop of failed private solutions that Treasury Secretary Henry Paulson and Federal Reserve Chairman Ben Bernanke made the consequential decision not to arrange a government-backed rescue for Lehman Brothers. Their primary concern was moral hazard that bailing out another major investment bank following the March rescue of Bear Stearns would only incentivize other firms to take excessive risks while expecting subsequent taxpayer protection. This proved to be one of the most devastating policy errors in modern financial history. While Paulson and Bernanke understood that Lehman's failure would be severe, they profoundly underestimated the systemic risks created by the utterly interconnected nature of derivative exposures linking every major global financial institution. When Lehman filed for Chapter 11, bankruptcy protection in the pre-dawn hours of Monday, September 15th, the immediate effect was a global financial panic that eclipsed anything witnessed since the 1930s. The firm's failure triggered an avalanche of collateral demands from derivative counterparties across the entire system, creating instant liquidity crises at institutions that had appeared rock solid just days earlier. Money market funds, previously considered the safest harbor for institutional cash, experienced massive, crippling redemptions as investors feared exposure to Lehman-related securities. The commercial paper markets, the lifeblood of short-term financing for major corporations, effectively shut down as investors fled any instrument carrying even a whiff of credit risk. International markets were hit with brutal force. European and Asian banks discovered their derivative exposures to Lehman were far larger and more toxic than previously calculated, necessitating immediate emergency government intervention to prevent their own collapse. The human toll was immediate and crushing. Lehman's 25,000 global employees were terminated with minimal notice, losing not just their careers, but often their retirement savings, which were heavily invested in company stock. The collapse wasn't just a Wall Street number. In Singapore, a retail investor named Mr. Tan, who lost his $50 billion life savings in Lehman-linked mini-bonds, suffered a heart attack right at the bank after being forcibly escorted out. Clients who had deposited securities for safekeeping found those assets frozen in bankruptcy proceedings that would drag on for years. But the broader economic consequences were epical. The credit markets, which supply essential financing to businesses, consumers, and governments, became utterly dysfunctional. Unemployment began a rapid, terrifying ascent as businesses found themselves unable to access the short-term capital required for normal operations. Within weeks, the crisis triggered by Lehman's demise had spiraled into the most severe economic recession since the Great Depression. Global GDP contracted sharply, unemployment levels reached historical highs, and governments worldwide were forced to implement unprecedented fiscal and monetary stimulus programs to avert total economic breakdown. More than a decade after Lehman Brothers filed for bankruptcy, pedestrians traversing Manhattan's financial district can still see the firm's imposing former headquarters at 745 7th Avenue, now occupied by entities having no historical link to the global investment bank that once wielded enormous financial power. The building remains architecturally identical, but the empire that operated within those walls has vanished as completely as if it had never existed. The name Lehman has become such a symbol of corporate greed that even the film Despicable Me features the Bank of Evil with a sign that reads, "Formerly Lehman Brothers." Yet, Lehman Brothers' influence on modern capitalism endures far beyond its physical disappearance. The financial innovations it pioneered, the predatory business models it established, and the catastrophic crisis it triggered continued to shape economic relationships worldwide in ways that the general public rarely recognizes or fully understands. The most visible legacy is the sweeping regulatory architecture that arose from the ashes of the collapse. The Dodd-Frank Act in the US, parallel European banking regulations, and intensified international capital requirements implemented since 2008 were all designed with one core purpose: to prevent another Lehman-style failure from causing systemic global panic. These regulations impose strict limits on bank leverage, mandate rigorous stress testing for major institutions, and require that systemically important firms maintain living wills designed to enable an orderly, non-bailout bankruptcy process. This high-leverage model has now migrated to the shadow banking sector, private equity and hedge funds, where the privatization of profits and socialization of risks continue. This predatory pattern, established on slavery money, allows institutions to capture gargantuan gains while leaving society to bear the moral and economic costs of their failure. The Lehman story reveals a core contradiction. Sustainable systems require balancing profit with stability, yet financial pressures reward maximum extraction. Today, despite being labeled the villain of the crisis, Richard Fuld runs Matrix Private Capital, managing wealth for the elite and publicly stating he has no regrets about the past. This individual lack of remorse is the perfect mirror for a systemic failure. The firm vaporized, eradicating $613 billion in value. But the fundamental problem remains: the privatization of profits and the socialization of risks. The saga of Lehman Brothers is a profound parable about the dark forces that continue to shape global capitalism. Their ultimate collapse suggests that such predatory model, built on escalating risk-taking, eventually exceed any capacity to control, triggering inevitable, self-destructive crises. We have seen how three brothers from a tiny Bavarian village transformed slave wealth into one of the most powerful financial empires in human history, only to watch that empire self-destruct through the same ruthless appetite for profit that had forged it in the first place. The complete Lehman Brothers story, from Montgomery cotton fields to Manhattan bankruptcy courts, reveals something profound and unnerving about the nature of American capitalism and the dark forces that continue to shape our economic system today. When stepping back to survey the full picture, the most striking aspect of the Lehman Brothers saga is neither their spectacular rise nor their dramatic collapse, but the chilling consistency with which they embodied both the greatest strengths and the most dangerous weaknesses of capitalist enterprise across a century and a half of American economic development. Their strengths were undeniable: a remarkable protean adaptability that allowed them to reinvent their core business model whenever circumstances demanded it, a true financial innovation that engineered new types of economic relationships and market mechanisms, and an analytical sophistication that enabled them to identify lucrative opportunities that their competitors missed. These capabilities allowed them to survive the Civil War, 2 world wars, the Great Depression, and countless smaller crises that decimated their peers. 15 years later, too big to fail institutions are larger and more complex, and the phantom of Lehman persists in a success at any cost culture. We are left with a chilling question: will we finally learn to harmonize individual incentives with collective needs, or are we irrevocably destined for a grander, globally interconnected collapse?